Hello, everyone. I'm John Humphreys. I'm the Executive Director of the Wisconsin Association for Equity and Funding, and I'm pleased to have Matt Silkey and Michele Wiberg back from PMA for our ongoing series of market updates. And today's is particularly interesting with regard to some recent excitement in the markets, both in terms of bonds and interest rates and banking. And Matt and Michele are going to answer everything about that. It's going to be spectacular. I can't wait to hear all the answers. And thank you very much for being with us again. It's fun to have you both with us, and I'm going to just turn it over to you guys. I know there may be some questions, and folks who are with us today, you should feel free to unmute and ask questions. And there may be a chat feature that you can use as well, but if not, feel free to unmute and just interrupt and ask away. So Matt, Michele, thanks again for being with us, and the floor is yours.
Thank you, John. This would be the third installment. I did share my screen. I do have some slides up. Are you able to see the slide deck I'm sharing? Great. All right. As John said, with me here is Michele Wiberg. We both work at PMA. I don't believe that we necessarily need our pictures up here because we have our faces on your screen right next to them. But Michele has had 30 years of industry experience working in securities and 15 years at PMA. I myself have 9 years of experience here and 6 with PMA. Kind of a real brief overview of things that we're going to be kind of touching on today. First, we're going to be touching on a bit of an economic update. Michelle's going to take you through some of the recent bank failures, as well as the intervention purchases and programs that have been instituted and carried through to prevent this from growing into a larger problem. We're going to discuss a couple of municipal borrowing considerations given where markets are at today. And then we'll close it out with some investment and banking considerations. So how to maybe capitalize on some of what we have out here in the market today. Real quick, just a high-level overview of PMA. PMA has been around since the 80s. The genesis of PMA was from a similar, a situation not too dissimilar from where we are today. The S&L crisis, when a number of governmental institutions lost quite a bit of money, and there was a need, if you will, for an analysis so that these governmental entities could better understand the financial health of the institutions where they were investing their money. And so that was the nexus of PMA, and it grew over the years. Many of the relationships that this business official had, who he shared this analysis with, asked him to then begin brokering CDs between these banks that he had relationships with, that he was analyzing the health of. Later on, we added a financial advisory arm, and here we are today, as of the end of 2022, with about $37.7 billion in assets under administration. And so PMA is who we work for, and WISC is who we serve. So two entities separate entirely. And so it's kind of important to make that disconnect as well. But first, I'm going to let Michele kind of run away with the economic update. So Michele.
Thank you, Matt. It's been an interesting few weeks here in March. So we wanted to talk about some really current events that I'm sure you've heard about, read about in the news, but we did have 3 banks fail. One that kind of failed on its own, closed its doors, Silvergate Bank, and then 2 that were closed by regulators, Silicon Valley Bank and Signature Bank. So I'm going to talk a bit about kind of the dynamics that went into those banks closing, and then sort of like, as Matt said, the reaction of the federal government to make sure that this didn't become a contagion or a systemic crisis like we had back in 2008 and 2009, when we had really just widespread bank failures. So starting with Silvergate Bank, they closed their doors on Wednesday, March 8th. This bank was largely invested in cryptocurrency type of businesses. And as they saw sort of deposits go down at the bank, given their exposure to that industry and that industry coming upon some hard times, they were forced to sell some Treasury securities and mortgage-backed securities that they held in their portfolio. So the bank held these investments that were our secure investments. However, when interest rates have increased so dramatically over the past 12 months, the value of those investments decreased. So it's important to note that the value of a US Treasury security, for example, is inverse to interest rates. So as interest rates go up, the value of those bonds that they held in their portfolio went down because they were purchased when rates were much lower. So they were forced to sell these investments at a loss, and really led to the bank becoming insolvent. Close on the heels of that, we had Silicon Valley Bank sort of having the same type of criteria. So one being that they were exposed largely to the tech industry, to tech startups, to venture capital. They had a large depositor base that had uninsured deposits. So a large percentage of the deposits in the bank were in excess of that $250,000 FDIC limit. And they had a lot of exposure to, again, having a large Treasury portfolio that when they needed to raise capital, much like Silvergate Bank, they went to the market to sell those securities at a significant loss. In the case of Silicon Valley Bank, they took a nearly $2 billion loss when they sold those US Treasury securities. They knew they had to raise money. They were going to do it via an equity offering. They were instructed by their investment bankers at Goldman Sachs to go ahead and sell the US Treasury securities. Hindsight, I'm not sure that was the best decision. That really sparked just widespread sort of panic by the depositors that had money at Silicon Valley Bank. Remember, a large amount of those deposits were uninsured. So that money went away very quickly. Those depositors were able to get at their cash, and they wanted that cash out immediately. They saw the fact that the banks sold these Treasury securities at a $2 billion loss as really a signal that the bank was in trouble, and it really sparked a run on the bank. That started kind of over the course of the day. I believe it was Wednesday of that week that they did the Treasury sale, and it was the bank run really happened Thursday that week into Friday, and on Friday that bank was closed by regulators. That is the second largest bank failure in the history of the United States. So it was a significant event. That bank at the time of its closure had $209 billion of assets, making it the 16th largest bank in the United States. So a really significant event that occurred on Friday, March 10th. What started to kind of cascade from there was depositors looking at banks that had sort of those same criteria, large amounts of uninsured deposits and large unrealized losses in terms of the investments they were holding, namely US Treasury securities. So that sparked the next bank to fail, really Signature Bank becoming almost collateral damage to what happened with Silicon Valley Bank. Investors saying, you know what, this looks and feels a lot like Silicon Valley Bank. We're going to start pulling money out of Signature Bank. And they started doing so in earnest on really Friday, March 10th. And by Sunday, March 12th, that bank was closed by regulators. So that happened sort of late in the afternoon on Sunday, March 12th. And almost simultaneous with that bank closing, the regulators came in and said, we're going to use this, what's called the systemic risk exception, and say that regardless of whether your deposit was insured or not, the federal government's going to backstop all losses from both of these bank failures. And in doing so, they hope to kind of calm the markets. And I think to some extent that worked. We didn't or haven't seen sort of widespread bank failures and that systemic contagion of the event because the Fed kind of stepped in and said, we're going to backstop all losses. I'll note that Treasury Secretary Janet Yellen has stressed that the government is prepared to take additional actions if warranted. So not just backstopping the losses of these banks that have failed, but potential future failures as well. So all of this is happening in the context of, the Federal Reserve. So if we move to the next slide and think about the Federal Open Market Committee meeting on March 22nd. So we had bank failures and a really tremendous amount of market turmoil because of those failures, not only that week, but the following week, as we lead up to the March 22nd meeting of the Federal Open Market Committee, which again is charged with setting interest rate policy, monetary policy, namely setting the Fed funds overnight rate. As we were approaching that meeting, prior to the bank failures, it was largely believed and all of the kind of consensus around at least a 25 basis point increase would occur at that meeting, potentially up to a 50 basis point increase. So some of the events that sort of happened ahead of March 22nd, we had strong job reports come out, we had the bank failures, we had sort of these dual kind of information out in the market. And so the Federal Reserve came into that meeting and decided to raise rates by 25 basis points. Certainly the turmoil in the banking sector, I think, helped lead to some of that consensus around only a 25 basis point increase versus a 50 basis point increase. We highlight on here, we talked on the previous slide specifically about Silvergate Bank, Silicon Valley Bank, and Signature Bank, talking here about just some of the pressure system-wide. We saw regional bank exchange traded fund indexes close down dramatically. We saw pressure from a bank, Credit Suisse, that had to get bailed out by both the Swiss government and eventually bought by UBS. So we just had sort of a widespread kind of shakeup in the banking sector. And I don't know about any of you on this call, but I'm really thankful that we got out of it so far with just the failures that we've mentioned at this point. Again, the Fed using that systemic risk exception probably has a lot to do with just calming the market in general. As we think about the federal funds rate and market expectations, moving to the next slide, just want to show you kind of how the feel of the market shifted dramatically as we looked at those bank failures. So what we're looking at here are interest rate futures, and this is helping us point to where we think the Fed is going to go. And we're looking at what the market expectations were for the Fed funds rate and where it would be at the Federal Reserve's meeting at the end of September of this year. So where are we heading over the next 6 months? On the right-hand side of this chart, we have what those Fed fund futures were telling us on February 22nd of 2023. And what they were telling us, and the shading is a little light here, but they were telling us that largely the probabilities were lying that Fed funds rate would be between 5.25 and 5.5% as of September 20 of 2023. The Federal Reserve's actions last week have that rate currently at 4.75 to 5%. So largely in February, a month ago, they thought rates were going to be, kind of continuing to increase over the next 6 months. Fast forward to March 22nd of 2023. Don't fast forward on the slide deck. Thanks, Matt. Fast forward to March 22nd of 2023, those probabilities changed dramatically. So whereas the largest bar last month was showing that the Fed funds rate would be at 5.25% to 5.5%, the largest bar now is saying that rate will be at 4.5 to 4.75, which is actually lower than where it is today. So that shift in mindset after we saw this banking crisis had us travel from rates increasing not only now, but for the next 6 months, to actually having rate cuts by the time that we get to that September Fed meeting. So kind of a not really an about face, but a really change in consensus around how much more the Fed is really going to have to move. Even though we did have Chairman Powell come out and say that he very much feels that the banking sector is sound and resilient. In other words, we'll get through this crisis, but also understanding that they are watching this very closely, and that I think pre-banking crisis versus sort of during banking crisis, their consensus around where rates are going has changed. They even changed language in their narrative to say they removed the words ongoing increases and just the Fed's thoughts about where rates are going. So I think that's really important. I think we will start to see, instead of ongoing increases for the next 6 months, that we'll start to see decreases in that time period.
Michele, can I ask you a question at this point?
You bet.
And I'm really not nearly as skilled and knowledgeable as a lot of the folks on this call, I'm sure, but it looked like, if you go back 2 slides, Matt, or one more, I'm sorry. There. So Silicon Valley Bank, March 8th, a $1.8 billion loss. That's like 1% of 209 billion. Which doesn't that doesn't seem that bad to me. So I guess, but maybe it's the issue is that they had a lot of those less valuable bonds now. And I guess there's the big debate, was this bad management or is this bad regulation? What's the requirement for diversity of their asset system, and why is that 1% so critical?
Well, I think a key piece here, it was a $2 billion loss, I want to say, on a $20 billion portfolio of securities. So it was a significant loss, so that represented like a 10% loss in the actual securities they were holding. So that context is I think probably really important. I agree with you, this whole debate over poor regulation or poor management, or a combination of both.
Mm-hmm.
Certainly there were changes in regulation post Dodd-Frank. Dodd-Frank was sweeping industry regulation after the 08-09 crisis and making sure that we didn't have really that whole too big to fail mentality, that we didn't have widespread systemic issues in the banking sector. And some of those were backed off for some of these smaller banks, some of those regulations. And that was a piece of what happened to Silicon Valley Bank. They had certain regulations that applied to them that were then backed off in, I think, around 2018 with some revisions to the Dodd-Frank Act. So a lot of that kind of all comes into play as we look at what recently happened in the banking sector.
Yeah, thank you.
So this just gives you an idea of more talk here about how things changed over the month of March. We have 4 sets of lines here that represent where U.S. Treasury yields have been over that month period, and we see a lot of change really in the curve over that month. So we have the first week of March, we have the second week of March, the third week of March, in parentheses we have banks, because that's when we saw the volatility in the banking sector, and we have the fourth week of March where we have FOMC. That's when the Fed met. And I think it's important to note here that we just saw rates just come down. As we look at volatility in the banking sector, we see a flight to quality. We see investors wanting to put funds in the U.S. Treasury market because they see that as a quality investment. And we'll talk about that, how that impacts the municipal market as well, which impacts you tremendously. But that flight to quality has rates go down. So we see all the lines shift. But what I think is also important is you see the steepness of the very short end of that curve. So from kind of the 0 to 6 month range, we see much higher rates for overnight money than we do for even 30-day money, which is really interesting, right? You would think that if you're investing out 30 days, your yield should be higher than if I'm just investing overnight. So just kind of a point of reference here, WISC that Matt Silkey mentioned previously, the Wisconsin Investment Series Cooperative, the liquid overnight rate in WISC right now is 4.89%. The 30-day U.S. Treasury bill is 4.22%. So more than 60 basis points between what you can get in overnight money versus investing out 30 days. So it's a really interesting sort of paradox we're living in right now, where there's just, much more of this demand in that overnight space than we have out 30 days. Hopefully that means we'll have a short-lived crisis, but certainly it's a factor that probably influences certain decisions that we're making in the near term. And much of that 30-day, that decrease in that 30-day yield happened over the last several weeks. So March 9th, that 30-day T-bill has gone down 30 basis points in yield. So it's been pretty dramatic what we've seen just over the course of the last several weeks. More evidence of drama and dramatic changes in interest rates. So the 2-year Treasury here is what we're looking at, whereas the last slide showed us really from 0 to 30 years. This is just focusing in on the 2-year Treasury, which is, as we say here, particularly sensitive to market expectations. Look how dramatically the 2-year Treasury moved since March 8th, from a 5.05% on that date to 3.96% on March 22nd. So, over 100 basis points or over 1% change in just the 2-year Treasury over that period of time. Again, more evidence really of that flight to quality. So there's a lot that goes into, where interest rates are, where interest rates are going. A big factor in here is going to be CPI as a measurement of inflation, something that's important to you as well as you look at wage costs, as well as other costs in the budget. But really important to note that we have really seen a precipitous drop in CPI, and therefore inflation is, beginning to be tamed here, from that high point of 9% down to our most recent measurement of 6%. So none of us has a crystal ball here, but we do believe that inflation and the measure of CPI will continue to decrease. Will it decrease at as dramatic of a rate as it has recently? Probably not. It might be in smaller sort of increments in the near term, but we do expect it to continue to decrease. There's a lot of different shades of blue here, but I think it's important to note how big of a component housing is in the current CPI measure. We do expect that to kind of revert back to its mean, that is kind of encompassing a larger portion than it has or should on a historical basis, and that we should see sort of some reversion back to the mean in housing at some point and see that start to come down. But currently it's obviously a big piece of the puzzle when we think about CPI. Questions on this section, maybe before we continue on, kind of just what has happened in the last several weeks in the banking sector, that how that's influenced Treasury rates. We'll talk a little bit more about how that might influence your own decisions when we hand it over to Matt in a few minutes, but any questions? Don't want to move too fast here.
I remember our last session, Matt, and you talked about an inverted yield curve. Was that in that 2-year Treasury? Was that the same kind of thing back then?
Yeah, so here we see the inversion of the yield curve. So we see where we have short-term rates being higher than the longer-term rates. So that condition has persisted. The whole yield curve has come down, and if anything, got even more of a steeper inversion in that very short end. As I described, that kind of difference between overnight money and 30-day money is just, really out of whack at this point.
Yeah. Other questions, anyone? Feel free to unmute and you can go on camera if you want, or you don't need to if you don't want to. All right. Well, no takers.
Perfect. So now kind of shifting to municipal bonds. So, as you sit here and think about what's gone on in the banking sector, that's certainly going to influence your investing decisions, which Matt is going to speak about. But how will that, or should that maybe influence your decisions to borrow money if you are, embarking on a referendum, or perhaps you've passed a referendum and you have debt to be issued? How is any of this sort of turmoil in the banking sector influence municipal rates? And the short answer is really not much. So, as where we see a lot of kind of flight to quality into the US Treasury market, we see some of that in the muni market, but it doesn't participate as equally as really that worldwide Treasury market. But we have seen rates just overall come down. So what we're looking at here is those same 4 data points in terms of time: first, second, third, and fourth week of March. And we're looking at the AAA, so a highest rating category of the municipal market index, and what that interest rate would be 1 year, 2 year, 3 year, out to a 20-year scale. So we see that being, kind of a much flatter curve than we saw in the US Treasury curve. And we see the same idea of it just kind of has all come down over the past 4 weeks. As a point of reference, a lot of, I think the median credit rating for Wisconsin school district is a AA. And issuing AA debt right now is around a 3.8%, just a point of reference for you. We showed a AAA curve there. So just wanted to, put it more back into your backyard versus what we see in the index. And then this is just taking that index and showing it to you over time, as well as for different durations of municipal debt issues. So we're showing from 2020 through today, and we're showing you what that index is for a 5-year debt issue, a 10-year, or a 20-year. I mean, if you're building a building, you're likely issuing 20-year debt, which is the maximum you can do in Wisconsin, but kind of wanted to show you what this has looked like over time. That spike that we see back in 2020 was essentially when COVID hit, and we had more of a liquidity crisis than anything. And we had really investors fleeing the market. So we had a short time period where interest rates spiked dramatically, came right back down, and we're at a sustained low level over the course of time, where the Federal Reserve kept interest rates essentially at 0. And now we see, as that's been trending upward, as the Fed has changed its stance in terms of monetary policy, has been increasing rates over the past 12 months, and you're seeing your borrowing rates increase accordingly. Somewhat of a decrease in most recent times, as we've talked about and saw on the previous chart, based on what the volatility we're seeing in the market due to the banking sector. Another chart for you here, just showing you the relationship between municipal debt rates for a 10-year maturity and Treasury yields for a 10-year maturity. A municipal rate should be lower than a Treasury rate because you issue on a tax-exempt basis, meaning an investor does not have to pay any income tax on those investments on a federal level, whereas they do if they buy a Treasury security. So we have the line going across, which represents if municipal rates were equal to Treasury rates. So anytime you see the graph above that line, our rates were actually higher than Treasury rates. And whenever you see it below, the municipal rate was lower than Treasury rates, which is where it should be. So I think this is really just showing us in the current market, we have kind of a normal, if there is such a thing, relationship between municipal rates and Treasury rates, versus you can see back when COVID hit, where our municipal rates really spiked up, as I mentioned on the previous graph, because we really just had investors leaving the market. And then lastly, just to kind of give you some assurance that, again, this banking crisis hasn't been terribly impactful on borrowers in the Wisconsin market. We're showing you here results of competitive sales in the market for the month of March. So going from left to right is chronological. So the March 6th being, what the first competitive sale we saw in the market, through March 21st on the far right-hand side, just showing you who those issuers were and the number of bids they received on their debt issuance in the market. So in our opinion, from March 6th, before we had several banks fail, to March 21st, where we had several banks failed and didn't even have the Federal Open Market Committee meeting yet. We don't see much difference in terms of demand for your debt issuances in the market. So we see that as a comforting fact as you, as issuers, think about going into the market. Going to shift gears over to, you and as investors making specific decisions. But again, I'll pause if there's any questions for me before I hand it over to Matt. All right, take it away, Matt.
Thank you very much, Michelle. I apologize about my miscues with the slides there. I promise that it'll be easy trails for the remainder of the presentation. So what does it all really mean for the investment side? Well, we never really want to get too far away from our guiding principles, which are and always have been safety, liquidity, and yield. These are the three pillars with which the founder of our company actually built his bidding process and built his relationships with school districts. Safety definitely being the primary goal here. We do not recommend ever that districts have deposits on hand at any institution that are going to be above any insured or collateralized dollar amount. Any deposits we always recommend should be collateralized or insured. That way, if something does happen, you will get your money back. Liquidity, obviously a close second, because we need to be able to meet our liabilities throughout the year. We shouldn't have to liquidate any investments that we have placed in order to meet those liabilities. We really want to invest to those liabilities. That way, there's less of a potential for any losses. And then yield. Obviously, yields right now are extraordinary compared to where they have been, especially on the liquid side. But how do you manage kind of going through this interest rate environment that we're in right now and not just want to stay liquid? Because that's where the peak interest rates are at right now. Real quick, I did take a look at just now, John, as it relates to your question. So 6 months ago when we had this presentation, the 1 month was at a 271, the 2 year was at a 394, the 5 year was at a 387, the 10 year was at a 392. Since then, fast forward to today, regardless of whatever happened in between, the 1 month is up 150 basis points. The 2 years up 60 basis points, and the 5 year and the 10 year are actually down 30 and 40 basis points respectively. So you really see the steepening of that curve over time, and we're so flat once you get out beyond that, about that 5 year mark. So there's just not a lot to look forward to for people who are really investing down the curve. Obviously, you have to keep in mind perspective of where liquid interest rates are going to be going, because you will be extending your yield beyond any liquid yields throughout time. But what will you be investing in, though? This is just kind of a quick recap of state statute allowable investments. A number of these are utilized within the WISC portfolio. Government securities, we've got treasuries and government agencies. The time deposits that we have been discussing for the pretty much the entirety of the beginning of this presentation, these certificates of deposit. So those are both FDIC insured and collateralized CDs. Again, we don't ever recommend having deposits on hand that are not collateralized above FDIC insurance. And then you have your LGIPs. So the Wisconsin state LGIP and WISC both have extremely comparable portfolios, both of which are built out of the securities that I just mentioned. You're going to see probably more treasuries and government agencies with the state pool than you will with WISC, because WISC does have the ability to kind of work with our banking side and add some of those collateralized banking deposits that are actually returning competitive yields as well. And then beyond that, we've got commercial paper, sort of asset-backed securities and repo. We do have the ability to work with districts on some of these state statute allowable investments, but we choose to more so utilize them in our pools because they do, while they do return more competitive yields most of the time, they do carry with them the idea that those are essentially corporate debt obligations as opposed to tax-backed obligations. And so we feel as though it's just a bit more riskier, and that risk is best diversified amongst participants. But like I said, when it's managed and it's within an investment advisory portfolio, that is something that we can utilize. But here is the yield curve looking from the beginning of March to when we created this March 22nd. So you can really see the downward pressure out the curve. You do see that rates were going up a little bit, and then they had dropped pretty precipitously there real quickly after the Fed's decision, but very flat across the board, very steep going up, and then steep kind of as we get through the 6 to sort of 15-month range. And what this tells me, given sort of with the expectation of where rates are going, is that if you do have the ability to invest out, there certainly are yields that can carry you beyond the steep end of the curve, so that when we arrive at the point when rates have dropped maybe 100 basis points, you will still be earning a competitive yield. Obviously, there are other risks involved with that. Reinvestment risk is probably most notable. But there are opportunities out there, even though the highest yields that you are seeing in the market right now are going to be in the shortest term. Oop. Oh, I said I wasn't going to make any more errors, darn it. So this graph right here is very representative of the environment that we're in with many of our bond proceeds clients. And so what you have is the 10-year AAA MMD tax exempt issue yield, and then you also have the 1-year US Treasury. So you can see that over time, the 10-year AAA has always tracked well above the 1-year Treasury. And where we are at today is that the 1-year Treasury sits about 150 to 200 basis points higher than what you're going to see with that borrowing yield. And so yeah, 150 to 200 basis points above that borrowing yield. And so we have a number of clients that are facing fairly substantial arbitrage liabilities that they will owe back to the IRS at some point. Obviously, there are spending expectations that can be met where all of these borrowing earnings can be kept. But given transportation and costs of goods, a lot of draw schedules have actually been sort of drawn out, and many of them have not been able to meet their spending exceptions in order to keep the entirety of their earnings. But it's really important to know that going into any potential bond proceeds portfolio, that arbitrage is never supposed to be looked at as a bad thing. It is not to the detriment of the portfolio to earn more than you can, just so long as you know that you're earning that and that you don't end up spending it, because the idea is that you should earn everything that you can. The timeline of the project is going to be the timeline of the project. It's never going to be the way that it was expected to be at the beginning. It's not going to be what it was expected to be even 6 months earlier. But so long as you earn as much as you can, and if you do owe, that you know that you owe, and that you don't end up spending those proceeds so that you can pay the IRS. So some of these yields that you are going to be looking at today, now keep in mind that these are about 100 basis points lower in some areas than where they were even 3 weeks ago. But if you take a sample district portfolio of $1 million, as of yesterday, you'd still be looking at around a 5% yield for some of our 9-month portfolios. So again, looking at where liquid interest rates are at right now and where they potentially could be, I see about a 50% chance of a 25 basis point hike in May and about a 50% chance of them standing pat. So there is a potential that liquid rates could push above 5% in the next coming months. But we don't want to ever recommend that people try and time the market. Our recommendation typically is that if you have the ability to invest out the curve to your liabilities, that you always do so, because things do change. As we saw 2 weeks ago, interest rates dropped about 100 basis points in a couple key areas. And so people that were waiting for that peak rate to invest out to probably lost their opportunity. So things do change. They can change quickly. It's important to understand your cash flow. Invest to those liabilities in your cash flow, and that's really the best way to optimize your yield in a portfolio. Any questions at all about any of these yields or projections that we were discussing here? No? Okay. Some key takeaways here for the presentation, and Michele, please feel free to jump in as you see fit. Again, it's really important just to focus on the safety of your money. There are 2 ways that we typically discuss people are able to increase the yield in their portfolios, and that's by either investing further out the curve or by losing a bit on the credit side. And so oftentimes, if there are excellent rates out there, there's this too good to be true sort of thought process that kind of goes into it. And so it can be important to really take a look at the underlying credit of that institution. So going back to what I had said before, we recommend that all deposits on hand are FDIC insured or collateralized above that. Here at PMA, we actually do have a number of relationships with regional and national banks that will offer fully collateralized money market options. So if you are at your local bank and you are sort of pushing up against that at times throughout your fiscal year, feel free to reach out and we can kind of take a look at if any of that makes sense for you. And then also, one of the things that I've been noticing with some of our newer clients recently is that they don't actually have on hand an investment policy. If you are interested in putting together an investment policy, it's always something that we recommend. Many of them really do just reference state statute, and that's okay. But we do feel as though that every district is different and that it's important to have these discussions beforehand, so that when you do have an opportunity to go and enter the market, it's not something that has to sort of delay your decision-making process. Cash flow, obviously matching your assets with your liabilities, and then consider the diversification of the investment vehicles you're in. So we had brought up WISC a few times. WISC is a very high quality investment. It is very well diversified. It does utilize the treasuries, the government agencies. There is banking product in there. And then again, I mentioned some of those investments that are state statute, but a little bit further down the risk line, the asset-backed securities and commercial paper and stuff like that, that we do utilize just for their yield, but to diversify the risk amongst all of WISC's about 300 participants. So Michele, any closing thoughts?
I mean, I would just add, I think this current situation with the banking sector just reminds us that there can and will be volatility. And so when we think about when you place a deposit at a bank to have, we call it a belt and suspenders approach. So you understand the credit worthiness of that bank, and you have that understanding via a quantitative analysis, as well as maybe you have a relationship with that bank where you can call those leaders and get a feel for the financials. But that deposit is also either backed by FDIC insurance, or if it's above that limit, it is collateralized or backed by a letter of credit. And to just understand what that collateral means, that you have a perfected security interest in that collateral. So there's a lot that goes into that. And I would just make sure that folks understand that will always be important. And I think this current volatility in the banking sector just reminds us of how important that is, that every dollar you have in a bank is protected. So with that, we're again happy to answer questions.
I don't have a question, but I guess I just wanted to circle back on, I think it was our first session, Matt, where you talked about a board action that they would take in order to invest with PMA. And I think we have the document that the board would approve to allow them to work with you. Does that ring a bell?
Yes, so WISC is an intergovernmental agreement. Right now, there are about 300 participants in the state of Wisconsin. About 200 of those participants are school districts. And so each one of those districts at some point in time felt that it would be worthwhile to bring on an investment consultant. And so they did that with an intergovernmental agreement resolution. So we just refer to it as the WISC resolution. It's about a 1.5-page document that just says you are going to abide by WISC's bylaws. And it is the only document that really needs to go before a board before being able to sort of capitalize on some of the offerings that we have here.
And does that address what you were just talking about with regard to an investment policy?
No, it does not. We do have a few examples of investment policies. I'm sure that many of you guys are connected with many business managers and superintendents from around the state that also have investment policies. So if you do not have one, I would recommend you either consult with them on how they put theirs together. Otherwise, we do have examples that we can provide and recommendations that we can make as to how to better build those out and how to make sure that they best serve the district that you work in. So
cool. Good. Anyone else? Questions, comments, thoughts, and ideas? A lot of interesting, complex information, and it's good to hear from folks who have such a deep understanding of all this. It's not something that I think your average superintendent really has focused on too much. So it's really, I think, very helpful. Thank you. Anybody else? Kind of last call. There's Paul.
Yeah, it'd be handy, Matt, if we could see some of those policy samples. Just because, we always want to look and see what we have and if we should do anything a little better. So I'd appreciate if you could shoot those out.
Yeah, I can provide them to John, and then John will go ahead and distribute them if that works. Otherwise, Paul, I can send them to you direct as well.
Okay,
Yeah,
thank you.
I'll drop them in the Google Drive with the slides from today's presentation.
All right.
All right. Well, thank you so much, Matt and Michele. Really appreciate your time. We'll look forward to our next market update and hope that there's less news to share. Thanks again. And on behalf of AEF, we really appreciate your time and expertise, and we'll look forward to seeing you again. Take care.
Thank you.
Thank you. Thank you, John.